quick context, this was recorded March 28th and 29th, so a couple of weeks ago at my live event, SaaSopen.com. We had 1,000 software CEOs there. If you missed it, we hope to see you at the next one, September 5th and 6th in New York City, SaaSopen.com. But for now, let's jump into the recording.
We have less than $10 million on the balance sheet and we're a public company.
He's effectively bought for $400 million of cash and stock, 2 companies totaling $80 million of top line revenue.
3 months ago, we won a deal that was $23 million of ARR with 1 customer.
Which restaurant are you guys most penetrated in right now in terms of the checkout terminal?
Most penetrated? Gosh, I'd say our largest deal is Burger King, but we're just starting to roll them out. So you'll probably see us in Dairy Queen, Arby's, Five Guys, Sweetgreen. So all
so you guys can see the logo here. You see it up here. When you guys check out on the station, these things, you'll see that hardware is PAR. And to describe how that legacy business, the audience can see sort of how it's flatlined, and then what you did when you came in.
So we were actually founded 56 years ago. So well before any of the management team was born. And we were originally a defense contractor. We sold IT services to the Department of Defense. Our company was called Pattern Analysis Recognition. We were Palantir before Palantir, so we were a little bit ahead of our time. Fast forward, in 1978, our founders invented the point of sale terminal. That's the device that you see the McDonald's cashier banging on. In 1982, we went public off the success of McDonald's actually saying, we're going to use that device across all our stores. We had a bunch of success, call it in the 80s. In the next 25, 30 years, we sort of had a long, slow decline. And it's primarily because we got stuck as a hardware and services company. So you'd buy our hardware and services, and you'd buy the software from Oracle or somebody else. And then in 2014, we sort of bought a small software company. 2018, I came in and started running the company on this idea that the restaurant was going to the cloud. And I thought the point of sale was going to be the fulcrum product. A lot of times I sort of think about, your careers are oftentimes built off of picking the right end market. You can see really, really smart people banging their heads trying to build a $10 million revenue business, where if they put their efforts into like a different industry, it'd be a $100 million business. And so what was fascinating about restaurants was they were just going through this idea of digital transformation. Every part of the workflow was becoming software, and we thought that the point of sale system would be the place to build off of.
This wasn't an easy recruitment, though. The board sort of sucked you and they said, Savneet, please lead our CEO search.
Yeah, I said no for a very long time. So I got on the board. This is a true story. I got on the board, I think February, March of 2018. And then within 2 or 3 months of joining the board, we had our prior CFO literally got sentenced to jail for stealing money. We were under DOJ and SEC investigation for bribery and corruption. Our employee NPS was -60. Our customer NPS was -50.
So don't complain if your co-founder quits, okay?
And so, I went to the board and said, hey, I know I'm the young guy, but I got to go see what the hell's going on. This is a little scary. This is my reputation. So I went and met the management team, and I went back to the board and said, my advice is we sell the company. We do have this really cool product, but it's like a few $1 million of revenue, and we've got $175 million of very average revenue. And so it's going to take forever for the software business to become meaningful. And so we're kind of, it's just not going to work. And so while it's a great, amazing product that has tremendous potential, point 2 is we're structured set up for failure. We have less than $10 million on the balance sheet, and we're a public company, which is kind of crazy. We have we have a culture where everybody doesn't swim the same direction. I remember asking all the executives, what's the best job you've ever had? And I literally went to the top 10, 11 people, and nobody said their current job. And that's crazy, because I was on the compensation committee, and you think somebody would lie to me and be like, oh, this is the greatest job I've ever had. And literally nobody said the same that this was their current job was their best job. And then I'd say, what's the vision? And everyone didn't have the same vision. And then, not to mention, we had this SEC investigation, DOJ investigation. We had 2 activist hedge funds come in trying to sell the company. And so I was like, let's sell the company. And the board is, unfortunately, as boards do, sort of said, hey, no, let's find a new CEO. So we spent a few months being CEO, and every month they said, take the job, take the job, take the job. So when I actually got the CEO job, it was really like, all right, nobody wants to be the CEO. We'll sell the company if you become the CEO and sell the company. And so that's how I got the job.
On that note, over the next 18 minutes, we're going to talk about product strategy, operation strategy that Savneet executed, and then also M&A strategy. I first want to start off with public markets, though, today, because at that high point, your revenue, $2.1 billion valuation, his revenue was half of what it is today. But today's valuation is half. What's going on with the public markets?
Not half, like a fifth. Markets go through cycles, and that was sort of the poster world where any enterprise software company was getting multiples that were wild. And so
you think you were overpriced at that peak?
Oh yeah, we had $30 million of software revenue at that peak. $30 million.
$2.1 billion valuation.
Yeah. Now we had a couple $100 million of other revenues, but maybe that was worth $300 or $400 million. But still, like 30 times, we were 30, 40 times ARR. And so I started going to our board and saying, we got to take advantage of this. And so we went out, we bought a $500 million business called Punch that's based here in Austin now. And we started using our stock because we thought it was very inflated. And so it was the greatest thing we ever did because it gave us tremendous scale. We use an inflated currency. Mm-hmm. And so the way to think about it is we're a $30 million SaaS business that had a $2 billion valuation. We bought a
Are you doing Task right now or Stuzo?
Neither. I'm doing that 2021.
Oh, Punch. Okay, got it.
Yeah, so we were $30 million revenue that was worth $2 billion. We bought another $30 million business for $500 million that was growing faster, had better retention, and for 25% of our value. So it's like a great deal. It's sort of like trading in a very overpriced thing for double at half the price. So we felt it was kind of an amazing strategy. Fast forward, we kind of realized that, gosh, that M&A motion worked really well. Mm-hmm. We were able to combine the companies well, integrate our cultures really well. And so in the last couple of years, we've started to accelerate on that M&A path.
So just so you guys can get your bearings, Savneet's named CEO right in 2018. He's officially coming and taking over. This is what the product strategy looks like in terms of the buckets. You correct me if anything I say is wrong. I'm just trying to get through this so we can get to the good deal stuff. The upper left, point of sale, was the core business. Everything else is where Savneet's trying to take the company now in terms of growth, in terms of product strategy, et cetera. So my question to you is, because a lot of software founders I think mess this up and wonder why they don't have this success, is sequencing. You have to do the right things in the right order. You can't just do the right things. So how do you decide how to do stadiums, for example, before hotels?
You got to listen to your customers. I think, business is a bunch of logical decisions oftentimes, and you've got to have, particularly enterprise software is different. If you're Apple and you're Steve Jobs, you've got to predict the future and tell people where they're going. But enterprise software, there's a little bit of that, but it's a lot more of listening to the needs of your customers. I joke, if I went to our customers at PAR today and said, hey, instead of me telling you your normal QBR about our product roadmap, I'm going to tell you about the future of AI. Like, they kick me out the room because they're going to say, like, no, that's really cool, but like, how are you solving my problems today? And so in enterprise software, I think one of the biggest mistakes CEOs do is you get really big, you get farther and farther from your customers. You create org charts that are completely functional, where you have one CRO, one CPO, so on and so forth, and the decision makers get farther and farther and farther from the customer. And so what I work really aggressively is how do we constantly redo our org charts so that the leaders are closer and closer to customers. And so that's kind of how we got there. And it's really simple. Restaurants are no longer growing in the United States, right? Mm-hmm. It's like we're over retail, we're over restaurant. And so the growth of the units of restaurants is now in stadiums. It's in convenience stores, EV charging stations. It's not going to be the net new box. And so we wanted to kind of pull our products in that way. And so that's kind of how you figure it out. But you have to just listen to your customers intently, and then obviously listen to your developers, and they'll sort of tell you what they're hearing from the customers as well. So
Savneet is not only listening, he's driving both organic growth and inorganic growth. Over the next 6 minutes, we're going to talk about the inorganic growth. What that means is acquisitions, buying revenue. If I ask you guys today, just to run through this math real quick, I'm going to ask you to yell it out. If you guys saw a $20 million or $30 million software company today with $5 million of true profits, right, Ben Murray? Not like someone with adjusted EBITDA where there's not real money at the bottom. Like true money profits, $5 million at the bottom. So 30 top line million, $5 million on the bottom. What would you guys pay for that company? Just think about it for a second. 30 million top line, 5 million EBITDA. What would you pay? On the count of three, yell it out. 1, 2, 3.
It's tough comment.
Dror, what would you pay? 150 million. Okay, anyone else? You think that's high or low? Matt, you taking the over the under. You've sold a company. Under. You think cheaper than 150. These guys, they're just like, wow, you're a great deal maker no matter what. Okay, we'll put this in a button. I'll put it in a button, then let's have me break it down. He's effectively bought for $400 million of cash and stock 2 companies totaling $80 million of top line revenue and over $20 million of profits. So 20 million of profits into 400 million. You guys can do that. That's a 20x EBITDA multiple. There's some SaaS founders that are like, I'm not going to sell unless it's a 20x top line revenue number. He's paying 20x EBITDA number. So break down the first acquisition. How did you get Task done?
Yeah, and listen, I think just on the valuation thing, I think it's important for everyone to remember that software is not software, it's not software. Not every software company deserves the same multiples. So you can have 2 different companies with the exact same metrics and they shouldn't trade the same. And so you've got to be very specific about what you're acquiring, what you're buying. You can see software companies growing at 100% that trade at 3 times, and you can see software companies growing 20% that will trade at 10 times. And you have to be very discerning about how you think about that. And the stuff that we look at PAR is we obsess over how sticky is that end market. Mm-hmm. In the end, you can't outgrow the churn of your end market. So if you're selling to an end market that is churning, you can pretend you have high net retention, but in the end, your cost of capital will be very expensive because that end market is churning super fast. So, if you're selling software to Uber drivers, like that's going to suck because those guys churn over a lot. If you're selling software to McDonald's, like that's a great business because McDonald's is probably not going out of business anytime soon. So we acquired a business called Task. It's based out in Sydney, Australia. They are, $47 million of ARR. We obviously leave a little, we undercut the numbers a little bit. They are McDonald's loyalty solution international. So if you go to France and open the loyalty app, that's McDonald's. That's Task. If you go to Japan, you go to Italy, the app is beautiful. It changes language, it changes menus, currencies, payment. I mean, it's incredibly complex. 6 billion API calls a month. Real scale. And so we discovered them because they do that for Starbucks in Australia, McDonald's, a bunch of other brands, and we were all US based. And what was the challenging thing we were finding out was our US customers, think of it as big US restaurant chains, are growing more outside the United States than the United States. And so
when you said that on the call, I didn't believe that because I'm going, well, all the McDonald's and obviously Russia have now shut down. The US economy is killing it. Why is McDonald's not growing faster than the US?
Because the footprint's already been built out. And by the way, McDonald's is the only one that's growing in the US again. They've sort of made a commitment to redo their store footprint, but the vast majority, like Popeyes, super fast growing chain, they've got 900 store openings, 800 international.
Wow.
And the Burger King's the same thing. And it's just because we are over-restauranted here, and so the growth is international. And so we wanted to kind of follow our customers. And the challenge was, when we started the company, our ARR, when we took over the company, our ARR was less than $10 million. 3 months ago, we won a deal that was $23 million of ARR with one customer a year. And so as we've gotten to these bigger and bigger customers, we realized that we can't just be like, oh, we're just going to service you in the US and find something else international. And so this was super synergistic from a product strategy perspective. We bought the business for, less than, call it 4 times ARR for a business that's been growing 30% a year with 100%, almost 100%, well over 100% net retention, gross retention at 96, 97. I mean, it's just really hard to find assets like this. And the reason we convinced them is, I used to joke that I wanted to start the Berkshire Hathaway of software. But what I realized was we're a growth business. But when you're a founder and you have to make that decision to sell your company, you still want your product to succeed. And so the reason we were able to convince Daniel and his
Pause right there. He'll tell you how I convinced him in the VIP room after this. So what you see here, we got to hold that part because it's a genius story. What you see here, though, I'm putting this up here because this is how a guy like this thinks about buying a company. You guys a lot are at the stage, revenue-wise, that you have, if you want to sell someone like this that you'd like to buy you, this is how he sells it internally. So notice it's not just financial metrics. It's the usage-based metrics you see up on the screen. Talk about some of the usage-based metrics you love.
A lot of things I asked for, in the second round of diligence was like, I want your telemetry data. I want to see are people actually using your product because, one of the things I find fascinating is, product-led founders are amazing at building product, but they're very bad at rationalizing product. And the reason why you want to rationalize product is not just a P&L exercise, which is, hey, you've got too much work going on parts of your product that your customers aren't using. It's actually, you are starving the investment in the products that people are using. So if you've got a product that has 25 widgets on it and 5 widgets are being used, those 20 widgets that you're spending money and time on are actually taking away from those 5. Mm-hmm. And so I love to get into the weeds. And one of the things that was very clear about this product was, holy crap, your platform is being used way more than you suggested, which to me means like, oh my God, these customers are never churning. Like, could you imagine having a product that gets $4 billion of transactions or 4 million transactions? Like, could you imagine the fear if you're the CIO and you're like, oh, I'm gonna change vendors now? Like, just imagine how scary that is, right? That's not going to happen. And so
I have to touch on the $4 billion. Is there a fintech product coming from you have a lot of data. So Square's got a massive credit business.
Yeah, so the first thing we're going to do is build a financing business and a payments business out of this, once the transaction closes.
Mm-hmm. Yeah, you'll have to meet Savneet in the hallway. He's got a great credit backstory here. But let's keep moving forward here with the second deal you did with Stuzo. How'd this get done?
Yeah, so
by the way, both of these were announced just 2 weeks ago. So you guys are getting it fresh off the presses. How'd this happen?
Yeah, so we. As I mentioned, restaurants are growing really fast within convenience stores and fuel stores. There's a great example. There's a chain called Casey's. Casey's is a large public company, sells convenience stores all across the country. They're also the 4th largest pizza company in the world. And so these C-stores wanted loyalty software. They wanted you to come in and say, hey, I got points for my order. I want you to stay loyal to my C-store. And so our loyalty, we have the largest loyalty product in restaurants. We're in 48 of the top 100 restaurants in the world. So if you have the Taco Bell app, that's us. And so that was kind of happening with C-stores. And so they started pulling us into the C-store market. We got in there and realized, holy crap, we have no idea what we're doing. Convenience stores have gas, they have EV charging, car washes, like just everything is different. And we're trying to bastardize our product for this market. And it was working, like we were winning tons of business here. But we realized that if we had to make a decision, which is, do we want to go all in on this market or do we want to get out of it? And so I went to our leader of this business and I said, you got 3 options. You can shut this business down and say, I'm just going to focus on restaurants. You can go buy somebody here and scale it and actually treat it like a real business, or you can try to sell it off. But we can't kind of do this from the side of our desk. Mm-hmm. And so we went and found Stuzo, who's by far the best in this market. It's a business that did 40, and by all these numbers are LTM, so these businesses are growing very nicely. Again, it's mixing multiples even more.
Last 12 months.
Yeah, so these are incredibly conservative multiples. So last year, the business did $40 million of revenue, $17 million of cash flow. We got it done at 170, 100 million bucks or 190 million bucks.
So 4.5x ARR
and 12 times cash flow. The business grew.
This is like so cheap. Guys, imagine, this blows my mind how cheap. You have to ask him how he does these deals. You just ask him in the hallway, he'll tell you the full story. It's incredible.
And again, it's the same kind of thing where they had a higher offer from another bidder, but we wanted to continue the story of like, let's build this into something successful, roll your equity, and so on and so forth. And so one of the things that's worked is, because we are a stable pair of hands, but because we are growth, we can show, join your baby to us, and we're going to build it and grow it and build something special. We can attract those founders. Like we're not, if you're a private equity, 100% private equity owned, it's a little bit harder. But for us, we kind of sell the vision of the future.
We're not going to spend a lot of time on this slide. We've got 5 minutes left, but this is how Sav has laid out the vision on his earnings calls. This is how they think about product strategy. Now, did you come up with open commerce, or?
That was their brand, but we're sort of morphing it and changing it.
Yep. The next thing I want to talk about is something that I want to try and get you to give the private company equivalent. You talk a ton about ARR per share.
Sure.
It's gone from like nothing to $6 of ARR per share, and you say the reason you do this is because there's real cash flow under every dollar of ARR. What's the equivalent for a private company?
Well, I think the question you need to think about is for every dollar you invest in the company, how much ARR is being driven by that? And the reason I say ARR as a proxy for cash flow is historically when sort of venture capital first started investing in software businesses, there was no earnings. Gross margins might have been depressed because you were still building out the infrastructure to scale. And so you had to make a bet of like, I think this business will have this terminal value of cash flow. This might be a 20% margin, a 10% margin. And so ARR was your way of saying, okay, if I think this is going to be a 20% margin business and I invest this at 5 times, I'm effectively buying in at 25 times cash flow. So you're sort of trying to back into that. And so what we realized was, well, while we were making, and we shouldn't talk about this, but PAR was a real mess. We had to completely rebuild our product. We were spending 100% of our revenue on R&D. It was crazy. We needed a measure of like, are we making progress? And so the way we figured out was, hey, we think we're going to be a 25% cash flow margin, maybe a 30% cash flow margin business one day. So if we assume that we have $6 of ARR per share, well, that means we have this much cash flow per share, which means we're doing well. And so the way I would encourage founders to think about it is for every dollar you raise, how much ARR are you generating from that, provided you think there's cash flow under that ARR.
And what would impress you?
It just depends how fast you're scaling. Like CAC to LTV is a proxy for this. But I sort of like to think about if you're going to raise a $100 million round and you can't generate $100 million of net new from that, like I start to get a little bit nervous.
So you love a founder that's raised less than their ARR. That'd be a good
over time. Oh, for sure. I mean, you kind of have to be, right? Because I think because you implicitly you're going to say my churn is like 0, but that's a total lie, right? And so I'm as an investor going to go, and even with these businesses, like these are both businesses, like the last best company, Stuzo, has never lost a customer. But when we're building our model, we're going to assume they're going to lose a customer, right? And so you've got to always underwrite to conservatism. And so my view is, if you raise $100 million, you should be able to generate $100 million of ARR off of that platform over time to pay back for the time that it takes to get to that $100 million.
Yeah. Great story there. Obviously, that continues to grow, and the market doesn't really care.
By the way, if this doesn't work, goes the other way, then you're like, oh my God, they're getting way more inefficient. It's a shortcut for inefficiency.
But you've got arbitrage right now with where the stock is valued relative to where you can buy at. You're also, you want to ask them about, just talk, I guess, really quickly about pricing power. The reason you can buy a company and not be the highest bidder is because you've used your moat to basically undercut their price and win deals and make them feel that. Talk a bit about that for 60 seconds.
Yeah, I'm answering it a completely different way, which is, I was a startup founder. I was in this audience, years ago. One of the biggest mistakes people make about software is that they build a product that solves a very niche need, and they're like, oh my God, my product's amazing. And you know what? All your customers tell you you're amazing because you're solving a very niche, narrow need. But then you wake up one day and the platform product comes in and it's like, hey, I can give you what those guys have for half the price. And that's kind of what happened with Teams and Slack and Zoom. And I always say, think about the products you love, whether it's like a DocuSign or a Zoom or all the concepts I just talked about, and look at what they trade at. They trade at like 3 times revenue. DocuSign's a great product. Zoom is a great product, but they trade at the shittiest multiples. And even though they're great products. Now think of the products you hate. ADP, SAP, literally think of all the products you hate the most. They trade at the highest multiples. You know why? Because the platform product is way more durable than the single vertical product. And it's the single biggest problem people make in investing and starting companies is they think because they get a lot of great feedback from their customers because they're solving one narrow need, they're worth 10 times revenue. In reality, it's not. And so when we are literally going to our companies and we're like, here's what's going to happen. You solve Stuzo. You're an amazing company. You make $17 million free cash flow, but you solve one need, which is loyalty. Wait till I'm the POS company and I go to your customers and say, hey, I'm going to give you 80% of what they have for half the cost. And oh, by the way, when you buy my product, now all your data is in one place. And so you can cut off all these other costs and you can build something better. And so a little bit is also sharing the vision of like, hey, I love what you're doing, but that is not a strategy to win. And so what our strategy was, we are the platform. We are call it the ERP of that market, and we can then bolt this stuff on more effectively. And listen, in the end, if you're a founder in the market and you talk to your customers and you're like, hey, do you want 20 vendors or do you want 5 vendors? Like, they're going to pick 5. And it happens over and over again. And so I would encourage all of you to think about like, are you the narrow niche vertical product or are you the platform? And if you're that narrow niche product and you get a great multiple exit, you should. And if you're not, then you should figure out how to build a platform.
Now, Savneet, before we wrap up, you founded CoVenture. You're very active in the debt space. You're also an investor in FounderPath. Talk a little bit about when founders should and should not think about debt.
I think debt is super exciting because it's non-dilutive and you can scale quickly. And obviously, the economics of what you just showed on for yourself. And FounderPath is like the most elegant solution I've seen for that. But at the same time, it can also kill you. And so what I would encourage you to think about is, what is the worst case scenario for my business, the true worst case? And then model out, can you support the debt under that worst case? And then that's how you should figure out how you should take on debt. You should not model a base case, model the worst case. And you'll be absolutely fine. The other part I would tell you is, it's do you want to grow fast or slow? And there are many bootstrap companies that take 20 years to become amazing businesses. And that instance, I wouldn't take on the debt. I would just fund it through yourself. But if you want to grow fast, I think it's a really nice complement to having potentially equity or bridging you to equity down the road.
Yep. Guys, on that note, if you want to learn more from Savneet and you have a gold badge, he's going to head back to the VIP room and do a 30-minute session private. You can ask him follow-up questions on anything we discussed today. But he opened up pretty big, took over a publicly traded company when it was stuck at $200 million of company at revenue at 34 years old. Then went in and said, I'm going to drive growth here, both inorganic and organic, up to $400 million of revenue. Continues to grow quickly, build a great team, and really, grow aggressively along this product roadmap and find great deals to buy at, I don't want to say bottom prices, but great deals. Guys, give it up for Savneet Singh.
Thank you.
Thanks, man. You're great.
Hey folks, if we haven't met yet, my name is Nathan Latka. I launched and sold my first software company back in 2015 and went on to write a book about it, which you guys made a Wall Street Journal bestseller, purchasing over 30,000 copies. Thank you so much for that. After the book, I launched this show and went on to create founderpath.com. I raised a large fund to do non-dilutive deals with B2B software founders. So far, we've invested in over 400 software founders, totaling $150 million. Here in 2024, we're doing 3 to 4 new deals per week. So if you're looking for capital and don't want to give up equity, go sign up at founderpath.com for free to get your offer.